All the reasons why stablecoins are awesome. There's a good chance that stablecoins will come up if you're planning to embrace cryptocurrency for things other than trading or investment. But keep in mind that not every stablecoin is the same. Depending on the one you choose, they keep their value stable through different methods and carry out different types of risks. Here are some things you should know about stablecoins. What are stablecoins? Stablecoins have emerged as a crucial part of a developing class of decentralized finance with no need for an intermediary like a bank or broker. Also, a few stablecoins, including Tether and USD Coin, already have some of the biggest market capitalizations in the cryptocurrency industry. Stablecoins are intended to provide more stability when compared to other cryptocurrencies. To prevent their values from fluctuating too much, some are backed by a reserve of the asset they represent, while others utilize algorithms or other techniques, which we'll go through in this video in detail. The value of the majority of cryptocurrencies is primarily governed by what the market dictates, and many people can buy them in the hope that their value will rise. But stablecoins are meant to have less volatility, meaning you won't have to peak at cryptocurrency prices the next week and realize that you missed out on a significant gain or loss if you spend a stablecoin that's correlated to the price of a dollar. Stablecoins are backed by a variety of assets, including other cryptocurrencies, precious metal, algorithmic functions, and conventional currencies like the US dollar. Even though stablecoins aren't meant to fluctuate, a cryptocurrency's level of risk, however, can be impacted by its backing. For example, a fiat-backed stablecoin may be more stable since it's connected to a centralized financial system with a central bank or other authoritative body that may intervene and regulate prices when values are unstable. In contrast, stablecoins that aren't connected to centralized financial institutions like a stablecoin backed by Bitcoin may shift dramatically and abruptly, in part because the thing the stablecoin is pegged to isn't under the jurisdiction of a regulatory body. So it's critical to choose your stablecoin wisely. But to do so, you'll need to understand all of the different types available. Let's go through each of them in turn. Fiat-backed stablecoins. First, there are fiat-backed stablecoins, which are referred to as an IOU since they are purchased with dollars or other fiat currencies and eventually redeemed for the original currency. In contrast to other cryptocurrencies whose values might change dramatically, fiat-backed stablecoins aspire to have relatively minor price swings. Take Solana as an example. Stablecoins are still relatively new, have a sketchy track record, and carry unforeseen dangers, so it's best to proceed with caution while investing in them. So this effectively means that they're not a 100% risk-free option. You can use Coinbase's USD Coin as an example, which can be exchanged on a 1-to-1 ratio for $1. CryptoBacked stablecoins. Then there are stablecoins that are supported by other crypto assets and are backed by crypto assets known as crypto-backed stablecoins, which are over-collateralized to safeguard the stablecoin's value because the underlying asset could be unstable. A $1 crypto-backed stablecoin, for instance, may be linked to an underlying $2 cryptocurrency asset, providing built-in safety nets that allow the stablecoin to maintain its $1 value if the value of the underlying cryptocurrency drops. These assets are less reliable than stablecoins backed by fiat currencies, so it's a good idea to keep track of the underlying cryptocurrency asset. You can take DAI, a cryptocurrency-backed stablecoin based on the Ethereum blockchain tied to the US dollar, as an example. Precious metal-backed stablecoins. The third kind of stablecoin are those that are backed by precious metals and rely on gold and other precious metals to keep their value stable. Although some members of the cryptocurrency community may view the centralization of these stablecoins as a problem, it actually shields them from the volatility of the market. That's because gold has historically been regarded as a hedge against inflation and stock market volatility, making it an attractive asset for portfolios in turbulent markets. A good example of this type of stablecoin is Digix. A stablecoin that's backed by gold allows investors to invest in the precious metal without having to worry about storing and relocating it. Algorithmic stablecoins. Finally, there are algorithmic stablecoins, which aren't backed by any asset and are perhaps the most complex stablecoins to understand. In order to prevent the coin's value from fluctuating excessively, these stablecoins utilize a proprietary algorithm. The way they do this is by using an algorithm which automatically adds more tokens to the supply in an effort to drive down the price if an algorithmic stablecoin's price is pegged to $1 USD but rises above that level. Similarly, if the price drops below $1, the supply is cut in an effort to jack up the price again. Although the number of tokens you hold will fluctuate with this kind of stablecoin, they'll still represent your share. According to its developers, AMPL is one algorithmic stablecoin that is less prone to fluctuations in demand. Why do people use stablecoins? So then, what actually makes these kinds of cryptocurrencies so popular? The answer is simple. Stablecoins are popular because they still allow for mobility and accessibility while being designed to survive volatility in a way that other cryptocurrencies are not. But the truth is, even if a cryptocurrency is more reliable, it's still decentralized and vulnerable to the restrictions imposed by a centralized authority. But people are still interested because they offer a gateway into the world of DeFi, with opportunities such as quicker money transfers, direct access to financial services, the privacy of financial data, and the avoidance of financial service costs. With the support of a traditional currency, centralized stablecoins offer a digital option. What's not to like? Because stablecoins are designed to maintain their prices rather than increase in value, they may not be the same sort of investment as other cryptocurrencies. For instance, throughout its existence, the value of the USD coin has barely drifted from its value of $1. Meanwhile, if you consider a crypto like Bitcoin, it was trading at $4,000 at the start of 2019, but by 2021, it was sometimes trading above $60,000. In contrast to risky assets, stablecoins can be used as a payment system, as we discussed in our previous video. Some stablecoin types can also be used for cryptocurrency staking, a method in which owners of cryptocurrencies can gain rewards by effectively leasing out their holdings to facilitate other transactions. But staking has risks, so be sure to research the nuances of the coin you choose to invest in. Are there any other risks? Absolutely. Stablecoins may be less erratic than other types of cryptocurrency, but they still operate on new technology, which may have bugs or limitations that aren't yet identified. Also, there's always a chance that you might forget the private keys that give you control of your crypto. Stablecoins as a payment system. Stablecoins provide special advantages, such as the ability to conduct transactions directly through cell phones without a bank account. If you reside in a nation where inflation is high, you can convert your money into a more stable currency. The Peruvian stablecoin called Sol Digital, which is linked to the value of the sol, the country's fiat currency, is one instance of how this concept works in the real world. People have utilized stablecoins to avoid fees connected with other cryptocurrencies because many cryptocurrency exchanges don't charge a fee when exchanging them. For instance, if you wanted to sell all of your Bitcoin, you could trade it for USDT and then buy dollars using that stablecoin. It also works the other way around. Cryptocurrency traders may convert dollars into a stablecoin like Tether before exchanging that coin for another coin. Compared to fiat currency and other cryptocurrencies, stablecoins have a number of advantages. The first benefit is that they transfer the stability of fiat currencies to the blockchain, making them more transparent and safer versions of fiat currencies that can communicate with blockchain-based apps. Stablecoins are available through a network of applications that give better rates than standard savings accounts, can be used as cash, and are less expensive for completing transactions than traditional fiat currencies. Holders of stablecoins may also borrow money against their coins in blockchain-based apps or get insurance to safeguard their digital assets in other applications. Due to their widespread acceptance on trading platforms and strong liquidity, stablecoins also speed things up and reduce the cost of international transfers. They can also be readily exchanged for fiat currencies. And it doesn't end there. With the same value as their reserve, commodity-backed stablecoins make precious metals and other commodities portable and more divvy. Gold, for example, can be used as a means of trade and even leased out to generate interest using these stablecoins. But stablecoins aren't perfect either. The main drawback of stablecoins is counterparty risk. The possibility that one party to an agreement could break its obligations is known as counterparty risk. In this scenario, a stablecoin issuer might not have the reserves they claim to have or might decline to redeem tokens for their reserves. Inaccuracies or possible issues might also go undetected during audits, which makes stablecoins that depend on central institutions and auditors vulnerable to human error. Secondly, stablecoins backed by fiat currencies are frequently held on commercial paper, a type of temporary unsecured loan. Since the business issuing the debt may not be able to meet its commitments, using commercial paper increases the counterparty risk. Risk premiums might also result from periods of market volatility or a failure to provide audits. Risk premiums are the financial reward that investors receive for taking on the risk of investing in a certain asset, such as stablecoins. The risk premiums reduce the stablecoin's value relative to their peg, making stablecoins purchases slightly more expensive than those made with fiat currency. Conclusion: if you were considering investing in one of these coins, it would probably be safer to stick with a coin that's backed by fiat currency or a tangible good. Unfortunately, there's no way to tell if a stablecoin is genuinely backed by anything due to the absence of regulation in this industry. If fraud is taking place, it typically only becomes apparent after a stressful period like it did with Luna, So take your steps very carefully.